Hey, what's happening, guys? Dan Dower here from Options in Play. So, what I want to talk to you today about is volatility strategy. Okay, strangles, straddles. Quick little reminder what the volatility strategy means. Right, strangles and straddles. We're looking for bigger moves, not necessarily in a direction. Right, I mean you're just looking for moves that exceed oftentimes the price to move. Okay, and if you follow me or if you follow Options in Play, then you know that around earnings season, and actually maybe even outside of earnings season too, on certain events, this is a strategy that I like to use pretty frequently, and I get a lot of questions. What am I looking for, or why did I go with this one? And I thought that this was a great opportunity to just kind of summarize my thoughts, summarize my screening process, go over some of the things I look for. So hopefully you guys can start to learn this on your own, or maybe just like pick up some tips here and there if this is something you already do, and you maybe just want to look at it a different way. All right. So this is what I call the perfect recipe for a volatility strategy. And what you're going to see is a few things here. They're not necessarily in order of importance. Just, you know, all of the things kind of combined, taken together, or make the perfect recipe. It's not just one, two, or three. It's kind of a combination of all of them. All right. So first off, consistency is key. All right. I want to see like the stock have a very consistent history of moving when it reports. So I often like to use the last two, three, maybe in like the four last quarters. So the reaction to the report, so how the stock moved top to bottom, point wise, or you could also use percentage wise too. I often prefer to use point wise. Really, when it comes to these volatility strategies, like I said, I mean, it's not necessarily, you're not looking for really like a directional move like you would with like a call or a put. You're looking for just a larger than priced in move. So, like I say here, the direction of those moves is secondary. They're a little bit less important. Um, you want to measure the magnitude of those previous moves, right? So first off, is it consistent? Does it consistently move? Yes, right? Then you want to measure the magnitude of those moves. So from the close, the day prior to when it reports, to the top or the bottom of like the pop or the drop the day that it does report, or maybe like the morning after it reports, right? Because a lot of stuff reports after the close. Um, so I want to see the average scale of the trading range the next day, and you can either measure that on a point wise or percentage wise. A big plus for me is an accelerating size of the swings. So if you see something go from maybe 5 points to 10 points to 15 points to 20 points, obviously that's accelerating size of moves around earnings, right? And like that's a good sign. All right, the technical picture, right? This might not come, may not be the first thing you think of when it comes to these things, because you're talking about earnings and you're talking about options, but technicals, they really do matter. They factor in a lot when it comes to these setups. And what I like personally is long consolidations, clear gaps, significant levels of support and resistance. These are what I'm screening for. This is what I'm looking for. And the reason why is because these are price points that can really trigger the breakouts or the breakdowns, and lead to what I call the earnings combo move, which is basically the priced in move, aka like the earnings move plus the technical move, right? So that's the two for the price of one is what I call it. So you get the earnings move, and maybe the earnings move triggers a consolidation breakout or breakdown, and then you get another move on top of that, right? So that's why I'm constantly screening for, again, consolidations, gaps, maybe like a 52-week high or 52-week low, or maybe like through multi-year resistance or multi-year support. These are always on my radar for names that are reporting around earnings, and they factor in whether something sets up well for a volatility strategy or not. On the opposite side, right, huge rally. So if a stock has a huge run or a huge drop right into earnings, or if it's in a very strong trend, a very steady stair-stepping trend, or very steady negative trend, right? Those to me would be slightly more negative, because that would mean that maybe the expectations have gotten too one-sided, right? Where the prospect of volatility might actually be lower because a lot of people are maybe either pricing in good news, pricing in bad news, or good news is widely expected, or negative news is widely expected, right? So those are what you kind of have to watch out for. Very big moves or very steady, aggressive trend into earnings. All right, options, right? I mean, this is obviously a video about options, so of course the pricing of the options matter, right? So you want to look at that priced in move, right? And you want to see how does that compare to the last 2, 3, 4 quarter average, right? Because you go over what it moved over the last 2, 3, 4 quarters, so you have an idea in your mind. And now how do the short-term weekly options compare to that, right? Are those options accounting for that technical picture you just screened for, right? Are those options pricing in the fact that maybe a stock has been in a 3-month consolidation and it's due for a bigger move once it finally breaks out, right? Or are those options factoring in the fact that the stock is maybe hanging above 2-year support and a significant breakdown could trigger a much greater fall, right? Also, are those options, so is that weekly straddle accounting for any major maybe stock specific or market specific headlines that may have come out, during like the interim since it last reported, or possibly just recently, right? Major market headlines seem to be popping up a lot more recently. So is this straddle or is this priced in move accounting for that? Now, just kind of quickly here, if the options are in line with that average, right? So if the price in move this quarter is in line with the 2 to 3 quarter average, then the technical picture for me needs to be very compelling to say that it has that earnings combo potential, right? Or right, there's going to have to be some sort of maybe major sector action, maybe overall market action, that's telling me that this quarter has the potential to be different, right? So if the options are in line with the average, then there's got to be something outside of that telling you that there could be a bigger than expected move. Now, if the options are below average, right? So if they're priced underneath what it's averaged the last 2, 3, 4 quarters, then what I'm looking at is possibly a straddle or a strangle that's going to be a targeted move roughly in line with the average. Okay, so the next example I show you will kind of like tell you what I mean by the second one here, but essentially, if it's below the 2, 3, 4 quarter average, then the straddle strangle may be targeting a move equal to that 2, 3, 4 quarter average. All right. So let's jump to a chart and I can walk you through this. So here's a good example of what I mean. Foot Locker. All right. Let me highlight this for you. So earnings here, here. The part of my circles are not going to be perfect. Here and here, right? So to go over our list again, it's a consistent mover, right? This is 4 quarters prior to the current quarter, right? What happened? Dropped, popped, popped, dropped. So I don't necessarily care about the direction. I just want to see that it moved. And each of those 4 quarters, it had a very clear, solid move, right? Now, in terms of the average, over those 4 quarters, the stock had averaged about 8.25, so 8.25. So mostly consistent. A little over 7, so 7.25, 8.5, 8.5, 9. So very consistent mover, right? The moves have been consistently above 8 points, so say about 8.25. So going into like this next report, right? Those are things I'm starting to factor in. Now, technical picture, okay? So this stock got hit very hard on its most recent print going in, right? And it was in a tight consolidation. Above, what you can see here was pretty critical long-term area of support, right? So it was in a relatively tight consolidation above 40, and what you'll recognize when I go back to the daily is that there is a well-defined gap underneath. Remember, I said gaps. So you have a consolidation, key technical levels, right? So 40 support, which is 2-year support. You have a well-defined gap above. You have a well-defined gap below, right? So consistent mover, consistent large mover, key technical levels of support, right? Consolidation, clear gaps, both above and below. Now, the last piece of the puzzle, option pricing, right? What was the options pricing? So going into the week, the straddle was looking for about a 5-point move. It had averaged over 8 points, so almost 8.25 over the previous 4 quarters, okay? Options were only pricing in about 5 this time around. Not only that, but there was clear gaps, like I said, clear gaps underneath, clear gaps above, and had been in a relatively tight consolidation right at key support for about 2 months. So that's why I felt like Foot Locker set up well for a volatility strategy, right? And in this case, because the options were pricing in a move below the 3-4 quarter average, the move was targeting the strategy was targeting a move in line with that average. So in this case, about 8, right? So what happened? Foot Locker missed, as you can see, missed and dropped, and guess what? Guess how much it moved that session? Just about 8 on the dot. Closed at 41.93. The day going in, the next day, the low was 33.12. So actually, it moved over. It closed at 34. The next day, the low of the next day was at 33, right, which was about 9 points. Closed at 34, which is just about 8 points on the dot. So that to me is, it was one of those names that set up well. There were multiple pieces of the puzzle that fit into place, right? And that's why a volatility strategy, I felt, looked interesting into earnings of Foot Locker that quarter. All right. So I hope this was helpful. I wanted to go over this a little bit more in depth, just highlight just a bunch of what I look for when I'm screening for these types of setups, the volatility setups, okay, straddles, strangles. I'd love for you guys to reach out if you have questions, so please don't hesitate. You know how to get in touch with me. I hope you have a wonderful night, and I look forward to speaking to you guys soon.